Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how are you?
I'm doing great, pal. Thanks for asking. Interesting to see. Earnings are winding down. We're seeing markets sustain this magnificent rally. But what has your attention this week?
You know, we're focused on Fed minutes coming out, also the continuing talks between China and the U.S.
It is interesting. Ever since the Fed came out and kind of changed their position, I shouldn't say kind of changed their position, dramatically changed their position, but we also have the ECB reporting some minutes this week. So this cohesive central bank message is really dovish, correct?
It absolutely is, no question.
All right, pal, let's get this first line here. Are you ready?
Absolutely, let's do this.
Gold surges. Interesting to see gold up on the day, about 1.5%. What's your takeaway as the precious metal has vaulted above 1,300 and now on its way to 1,350?
It has really rallied alongside with the marketplace, and you usually don't see that. You don't see, typically gold moving in the same direction as the market.
It's interesting, all in the face of the U.S. dollar getting a little bit stronger.
Yep.
But what type of trading example would you possibly express as we've seen just this recent surge in volatility as well as the price?
I'm looking to fade the recent surge in gold, and the way to potentially express this would be by selling the March week 1 1350 call and buying the March week 1 1375 call.
That's interesting. So you want to utilize this recent volatility increase to your favor, collect that extra premium as that at the money, that initial 1350 call you're selling is a little bit closer to the at the money underlying, correct?
Right, like you just said, Jeff, being that it is closer to the money, I will be able to collect a little bit more. So an investor can collect about $430 as long as the gold April futures price remains under $1350.
And this was all when that April future was trading around 1341, which is interesting because that at the money volatility was up above 10 at about 10.5%. And remember, this trade example expires on March 1st. Therefore, Scott, what is your break-even point on this?
That would be at 1354.30, Jeff.
Great stuff, Scott. And please remember, these are trade examples, not trade recommendations. You ready for the second lightning round?
Absolutely.
Trade tariffs. Well, we have trade tariffs front and center yet again. What are your thoughts here? There's a lot of optimism in the market as we see this March 1st deadline kind of looking at the market right in the face.
It is right around the corner here, and the risk headline is you just don't know what's going to happen. We've had this huge rally on the thoughts that maybe we are going to get some good news coming out here. We'll have to wait and see.
We hit the nail on the head for my trade example. We talk about risk mitigation, we talk about hedging. We've also seen just a sensational rally, specific in the E-mini NASDAQ. So when you look at what you can potentially utilize in your toolbox, I like buying a put spread, more due to the fact that you've seen volatility subdued. Look at the VIX, it's really come down. Therefore, to buy a put spread is very inexpensive. Would you agree with that statement?
Absolutely. It's really inverse to the volatility that we used earlier when we were looking at the gold example.
So Scott, I want to be a buyer of a 6750, 6500 put spread in the E-mini NASDAQ. I'm buying the week 2, that's 1 week past years. Gets us out to March 8th. This is going to cost me, or an investor potentially, $320. And when you put that in the bigger picture, if you see the market continue to move higher, this will obviously go away. You defined your risk. But if the market does pull back in any shape, form, or fashion, you will see this put spread really move to the upside.
No doubt about it. And the contract was trading around 7,065 here. And at the money vol, like you had said, Jeff, was really depressed down at 16.17.
And that brings this break-even point on this trade example to 67.3340. Therefore, Scott, I think if you do see any type of optimism get broken by some communication or rhetoric out of DC, I think we do see the markets have a knee-jerk reaction. And that's where a hedging tool like these options on future come into play.
And you are always risk-defined on a spread like this.
All right, Scott, thanks as always for hopping on to Striking Options. I want to thank you for tuning in to Striking Options. Please tune in every week as we will continue to strike options.